Hello there. Welcome to Commodities. Let's get to that energy complex right now, because two pieces of bad news on the geopolitical front. The traders are pricing in possible supply disruptions, possibly launched by Iran unilaterally. There are concerns that talks between the US and Iran are not going as well as hoped on reducing Iran's or curtailing Iran's nuclear program, trying to prevent that regime in Tehran from getting nuclear weapons. And also, we saw talks break down, or certainly end, in Geneva between Ukraine and Russia with no apparent progress. And of course, that would tend to keep Russian oil off the market, or certainly subject to sanctions if the war continues, and tend to tighten the world oil market. So quite a move up, 5% in crude right now. Iranian state media said that Iran was temporarily shutting down parts of that vital Strait of Hormuz, through which a big chunk of the world's oil goes every day, and about 20% of the natural gas. The regime's Revolutionary Guards conducting military drills there. It's not clear whether the Hormuz Strait has been fully reopened. And let's have a look at where the metals have been trading today. And you can see an apparent search for a haven. Gold up, as just in real time there, topping $5,000 US an ounce. Copper also higher. Andy Holm, economist at Reuters, says really you shouldn't be panicking here, though the world has not run out of copper. There's plenty of talk about shortfalls because of massive demand for data centers, etc. But there are huge stockpiles. The amount of copper apparently held by the world's big three metal exchanges now above the 1.1 million metric ton level for the first time since early 2003. However, we've seen a massive move up in copper to record highs over the past couple of weeks. So we know that there was distortion here because of the tariff threat in the US, and the Americans did impose more limited tariffs on copper than had been expected, produced a huge buildup in the United States. But we've also seen Shanghai and London experiencing accelerated inflows. And some commodity-related stories we're bringing you today. Shares in Northern Dynasty Minerals sliding. That company wants to build a controversial and gigantic gold and copper mine in Alaska. It's been trying for a decade or more to do that. Now the U.S. Justice Department says it's upholding a previously imposed veto on mining at that Pebble deposit. Rio Tinto has taken majority control of Canada's Nemaska Lithium. That mining company has made several investments and is now at 54%. It's boosting lithium projects in Quebec, and it expects to invest about $300 million this year in its Quebec lithium business, with production expected to start in 2028, according to Bloomberg. And Bloomberg also says it plans even more spending to move ahead with its Galaxy hard rock lithium development in Quebec. We'll have more about that later on the show. And shares in Capstone, a copper, getting a hiding. The company produced a forecast for 2026 output that missed analyst expectations, and cash costs, full-year cash costs higher than expected. The company's mine in Chile is expected to see lower production. Let's get back to gold. We've seen a move up in bullion today amid these simmering geopolitical risks. Let's get more from Helen Amos, Managing Director and Commodities Analyst at BMO Equity Research. Helen, great to see you again. It's been quite a while since we talked. Really appreciate it.
Great to be back. Hi, Andrew.
Tell us what are clients, what are colleagues asking you about gold right now, and what are you telling them?
Yeah, I mean, there's still a lot of excitement over the space. I mean, I know we've had a lot of volatility as well, but fundamentally, investors still like metals and mining. We're telling investors that, stay in the space, stay in gold and copper. They're our top picks for commodities this year. And there's just so many drivers all layering up together. You've got emerging market momentum, you've got this deglobalization theme. You've got de-dollarization, it's particularly benefiting the precious metals. And then, of course, you've got, strong retail and investment interest as well, which looks pretty secure. And every time we've had a bit of a pullback in gold, it's found a really nice solid base very soon.
You've been working on a bull case for gold. Now, it's not your base case. It's not the most likely scenario that you envisage. But your numbers came out at a price potentially north of 6,300 by the end of this year, and then getting up to north of 8,600 by the end of 2027. Tell us about some of the inputs you used for that.
Yeah, sure. So, we've got a regression model that we run for gold. It's becoming increasingly difficult to keep up with gold's moves. But what we find is that we can still broadly explain its performance based on the central bank demand, ETF flows, the US dollar index, and 10-year TIPS yield. So what we said is, imagine if for the next couple of years we see the same pace of investment demand as we saw in the first year of Trump's second term. So we ran a similar or slightly higher rate of central bank purchases through pace of ETF flows, and that's what brought us to almost 6,500 by the end of this year. So it just shows you how easy it is to get to these higher prices.
But your base case, maybe you can put that chart up, but but your base case for gold is a slight decline over the next few months?
Yeah, I mean, look, it's, with commodity price forecasting, the world is changing rapidly.
Yes.
We last put out our base case deck a couple of months ago. And the point we made in this bull case note is that the world has changed. In January, we just had a huge number of geopolitical flashpoints, I would say. We had Venezuela, we had Greenland, we had concerns over Fed independence, all happening at once. So I would say that in the course of those few weeks that we published our base case, the risks are definitely now skewed to the upside, so towards our bull case.
Can we turn to copper? Is there, you may have heard that analysis by Andy Holm of Reuters saying that really the inventories don't point to a shortage of copper. What is your take on that?
Yeah, I think we've got to be really careful here. I mean, conventional commodity research analysis would say when visible exchange inventories are rising, that's bad for prices. However, I think we're in a different era now. One big driver of copper has been the fact that we've had this regional stockpiling. So, very big increase in US stocks to around 1 million tons. China has also now publicly said that they are doubling down on their own stockpiling, which we think they've been doing for decades anyway. So I think when we've got that context, I don't think we can necessarily use the usual toolbox. And I certainly feel like at the moment we shouldn't be stacking up regional stockpile all as one block and drawing any conclusions from that. So for us, we actually think the stockpiling dynamic probably has further to run. We're still seeing very strong inflows of refined copper into the US, and we track high frequency data. So I would still expect stockpiling to continue from here.
This is something I know you've done a lot of work on. If you could just comment on it, that we hear a lot about, America's access to raw copper, that needs copper mines, etc. But I think you and other observers have been pointing out it's really processing that America is short of.
Yeah, that's right. I mean, we did this piece last year where we said, actually, if you look at the trade balance for the US on a copper unit basis, it doesn't really show a problem. It's just that the US is exporting a lot of scrap at the moment, which it doesn't have the processing capacity to absorb. Now, there have been a couple of new small secondary smelters, so they're smelters that can utilize scrap. They've been coming up over the last 12 months. Now, they were in the pipeline anyway, so that's not in response to anything on tariffs. But, and I think it's fair to say that even in the next 3 years, it's going to be very difficult to bring on new mine supply in the US. So really, I think it's down to, we need to see a pickup of investment in secondary smelting capacity. That would be the quickest way now that the US can close this import gap. But we're keeping an eye on the situation, but we haven't really seen any major announcements as yet.
Just finally on silver, you reckon silver could be ahead of itself in terms of its ratio to gold. We've seen it lately hit the lowest ratio to gold in years.
Yeah, absolutely. I mean, we're a little bit wary on silver now for the time being. For us, it's mainly an industrial commodity still in our eyes. Now, we've got the physical market balance. It actually is probably starting to loosen now. We think we've passed the peak in global solar installations. And I do think retail investors got a bit carried away over December and January, probably on the debasement theme. We had a lot of speculative activity and a lot of options trading as well that pushed that up. So I think, it's come back down to earth. I think all of that volatility that we had didn't do silver any favors in terms of its reputation as a safe haven asset. So look, we are keeping an eye on any changes that might affect its status as an investment or safe haven asset. The situation is obviously quite fluid, but for now, physical market balance looks like we're through the worst of that for now.
Helen, thank you very much. I really, really appreciate it. Helen Amos, Managing Director and Commodities Analyst at BMO Equity Research. Coming up, we are watching oil with this potential military escalation between Washington and Tehran. We'll have more after the break. So it looks like the Americans and the Iranians, who to some extent have been negotiating in public, are not making progress to satisfy Washington on Iran's nuclear program. We have seen oil going up today because, of course, America might go for yet more sanctions and restrictions on Iranian oil exports. And meanwhile, U.S. President Donald Trump has deployed another carrier, the Abraham Lincoln, to the Middle East, joining. And we've also got the Gerald Ford en route to the region. Let's get more from Bob McNally, founder and president of Rapidan Energy Group. Bob, great to see you as ever. Do we know what the sticking point here is, what Washington is demanding that Iran will not grant?
Hi, Andrew. I think we know part of it, but we have to assume there's a lot we don't know. There's a lot of intelligence we don't know and factors we don't know. But what we do know is that Donald Trump really has a thing about nuclear weapons, Andrew. He really wants to see that regime separated from its weapons capability. And Iran is willing, it appears, to make gestures in that direction, but not enough to satisfy President Trump. He wants no enrichment. He wants the stockpile of highly enriched uranium that Iran has made moved out. And then he wants intrusive inspections to make sure it all sticks. That's like a bare minimum before we get to the missiles that Iran is rebuilding, which is a problem for Israel as well as the U.S. So those are the sticking points. And so far, there just doesn't seem to be the deal space.
You think that there is a chance that if the United States launches attacks on Iran to try to bring them around, this time the oil industry, oil facilities could be a target?
Well, I certainly think energy production and flows through Hormuz will be a target. So about 20 million barrels a day of mostly crude oil, but also a good amount of refined products. And then let's not forget 20% of world's LNG from Ras Laffan flows through. The Iranians practiced closing the Straits of Hormuz yesterday. They have said over and over this time they will do that. So I think interfering with the flow of energy is more likely. Do I think Iran will attack Gulf energy infrastructure? I think that's less likely. They are on better terms with Saudi Arabia now than they were the last time they attacked energy facilities back in 2019.
We've been talking about this for decades, the possibility that Iran would move to make the Strait of Hormuz too dangerous, maybe with mines or just harassing tankers with small patrol boats. Will they go that far, do you think? Because obviously the West Britain, European countries, the US would be likely to react.
They would. And as you noted, Andrew, the Iranian military and the U.S. and its allies have been preparing for a battle over Hormuz for decades. And Iran, in our view, our understanding, and we've consulted with military officers about this, is Iran does have the capability to make Hormuz unsafe for a lot longer than traders probably expect, measured in weeks. Consider, Andrew, in April, the Houthis held off the U.S. for 52 days. We pummeled them, and we lost. We were unable to subdue them. And the Iranians have much better weaponry and more of it, and a much better coastline to operate from than the Houthis did. So I think the U.S. would win in a conflict, but it might last longer than a few hours or a few days.
And of course, insurance rates, etc., would skyrocket.
Precisely. Even if there isn't constant sort of battle occurring in the strait, the risk of it will cause the insurance companies and the tanker owners to want to hold back and make sure that passage is safe. You don't have to have constant sort of a fighting to prevent the shipping.
Could we switch to refining in the U.S., specifically the feedstock for U.S. refiners, the likes of Marathon or Valero? They've been doing just fine lately, have they, with relatively cheap feedstock?
They've had an extended holiday season, that's for sure. You know, it started out in the fourth quarter. Heating oil margins are quite good. The U.S. at the high end of their 5-year range. Demand is not peaking for refined products like many had been predicting. We are shutting down refining capacity, though. So it's a tighter market. The U.S. has very efficient refiners, and they were making margins that were $5 a barrel higher than they were the year before. Then, after Christmas, President Trump intervened in Venezuela with the effect of suddenly making, hundreds of thousands of barrels a day of that prized sulfurous Venezuelan oil available to them. And we see now they are buying, they intend to buy, they want to buy directly from the Venezuelans. So that lowered the feedstock costs. So yeah, profits doing well. It's been a great time for those heavy, sort of complex Gulf refiners in the United States.
It's certainly interesting. And also we've had a widening discount on our oil lately, partly because some Canadian maintenance projects came back quicker than people had thought.
That's right. I think that's right. And there was a fear, I know, a few weeks ago that suddenly Venezuela would replace Canada. We don't believe that at all. Most of Canada's exports go right into the Midwest of the United States. They can't and don't flow down entirely down to the Gulf. They won't compete with Venezuelan barrels. That Midwest part of the United States is pipeline locked. And so, yes, of course, you'll see the differential will go up and down based on various things. And no doubt in the Gulf, the Venezuelan barrels are adding to pressure. But I think Canada's position as a major supplier to the U.S. Midwest is assured.
Thank you very much, Bob. Really appreciate it. Bob McNally, founder and president of Rapidan Energy Group. Up next, we're going to get more on Rio Tinto buying a bigger stake, taking majority control of Canada's Nemaska Lithium. Rio Tinto is hungry for this energy metal from Quebec. Rio Tinto, the global mining giant, has taken majority control of Canada's Nemaska Lithium. It has made several investments to push its stake to 54%. It wants to produce this metal in Quebec. Let's get more from Bloomberg's Mathieu Dion. Mathieu, thanks very much for joining us. Nemaska now, as far as I can see, is a privately held company. It's not publicly traded. But can you walk us through the details of this deal?
Yeah, so let's remind you that Rio Tinto acquired 50% of Nemaska Lithium when it acquired Arcadium Lithium last year in a $6.7 billion deal. So
Right.
that came with Nemaska Lithium, right? And they had a 50% stake there. There were some cash calls made over the past few months to invest in Nemaska Lithium, and the other half is owned by Investissement Québec, the Quebec government's financial arm. So Investissement Québec didn't add money, so the cash calls were all covered by Rio Tinto, and that's how Rio Tinto took control of the company and now owns a 54% stake. Also announced today by the company, Rio Tinto will invest $300 million in its Quebec lithium business, and Investissement Québec will pour in a last $200 million. Since 2020, they've invested $1.1 billion. That's in Canadian dollars. So over time, you can expect the stake of Rio to increase and the one of Investissement Québec to decrease. Today, the money that's announced will go to finish a construction of a plant in Bécancour. The plant converts spodumene into lithium hydroxide. It's a material that goes into batteries, and in this case, the batteries will go into electric vehicles. We know that Ford has a long-term supply agreement with Nemaska to buy almost half of the output of the Bécancour plant that will start production in 2028. And you can expect Rio Tinto to add more money as they will need to ramp up the production over time. And so they're not done investing in Nemaska Lithium. Maybe worth mentioning that in a strategic update in December, Rio Tinto said that they were going to invest $1 billion per year over 3 years to grow the lithium business in Canada and Argentina. The bulk of it is in Argentina, but Canada is set to play a big role here in the lithium business for Rio Tinto.
And Mathieu, sorry, can you remind us what's being done about a processing plant? Where is that going to be, or what's the plan?
So it's spodumene. So they're essentially taking lithium concentrate and they will convert it into lithium hydroxide, which is another component. I'm not an expert to talk to you and expand on lithium hydroxide, but essentially that's what the plant is going to do.
Fascinating, yeah. I mean, Australia, as you probably know, is the dominant source of this hard rock lithium, but amazing that Rio Tinto, or interesting that Rio Tinto sees Quebec as a valuable source as well. Thank you very much indeed.
And maybe just worth mentioning that there's also mining operations in lithium in Quebec in which Rio is invested. There are two projects, actually. Nemaska's Wabushi mine and Rio Tinto's Galaxy project, and they're likely to invest more in the Galaxy project.
That's quite a boost for Quebec's mining scene. Thank you very much, Mathieu. Really appreciate it. Bloomberg's Mathieu Dion. We're out of time on commodities. We have the close coming up next.